this. I'm getting better and better with this whole process of Facebook Live using Zoom. Hopefully you guys are not hearing any feedback. Hopefully you guys are feeling safe, feeling healthy, feeling sane. Very important to feel sane in this otherwise insane world. And please bear with me as I kind of fidget with the camera and try to get the right angle for, as I've joked before, a face made for radio. Here we are. It is 2 p.m. in the Pacific Northwest, Thursday afternoon, and I really appreciate you guys taking a little bit of time to chat with me about what's going on in the markets and what's going on in real estate, mortgage lending. I'm working with my friend and colleague Dana, who's showing me in real time what I look like on Facebook Live. Heaven help us, guys. You're enduring a lot of grief, I assure you, but hopefully this is working out okay. Good enough? Yeah, okay, cool. We're here. We're in the beautiful studios of New American Funding. I am trying to get my act together, as we used to say in Texas, get my poop in a group. And as always, I am a little bit flustered because I don't do this all the time. And even if I had done it all the time, I'm not as good at it as I'd like to be. But let's jump right into talking about what's happening and what's not happening. And this is not stage makeup. This was and is the remnants of a tan. I took a trip away last week, which is why I missed you guys, and got a little bit of suntan. And now it's fading, of course, because, well, we're in the winter time, but it was also my birthday. And for those of you who see my pictures, yes, I did eat that entire tomahawk steak. Yes, I was sick as a dog the next day. I don't care. I'm doing it again next year. So maybe I'll even do it on video next time. It was an awesome steak. Highly recommend it. 40 ounces, but that includes the bone, which you saw me gnawing on. So really, it was probably closer to like 32 ounces, which is only 2 pounds. So come on, really. In the professional ranks, that's not even up there in the top 10%. So we're working on it for next year. But in the meantime, let's talk about what's going on in mortgage lending and in real estate and with the economy in general. As I said in the teaser, the Fed yesterday did as they were expected to do, and they raised their short-term interest rates by another 25 basis points, or 1/4%. And the markets were expecting that. That was not a surprise. It didn't shock anybody. The markets had priced that in, as we say, baked into the cake. And great, that worked out just fine. The Fed funds rate now is somewhere between 4.5 and 4.75. And what that rate is, it's not your mortgage rate. I wish it was. It's not your mortgage rate. What that is the amount or the rate that the Federal Reserve Board charges its member banks for short-term loans. So if I am a bank, I wish I was, but if I was a bank and I needed to borrow money overnight, they say overnight, but it's not really overnight, guys. It's like for a month or 6 weeks or maybe even 3 months. It's a short-term loan. But if I needed to borrow money from the Fed at a short-term duration, they would charge me somewhere between 4.5 and 4.75%. That's the rate that they keep jacking up. And they have jacked it up over the last almost year now, consistently. In March of 2022, this rate was zero. There we go, zero. Which means basically that if I was a bank and I needed to borrow money for short term from the Fed, then I could borrow that money for practically nothing. And man, when it costs you nothing, then you can do all sorts of things with other people's money. And that's what we had. We had this massive expansion in our economy because the banks, think about it from the bank's perspective. I'm the bank, right? And you guys come to me and you say, hey, I want to borrow money for a new facility. I want to borrow money to expand my business. I want to borrow money to do any number of other things. And I'm going to loan that money to you at 4% or 5% or whatever that rate was at that time. But I knew that I had a safety net that I could borrow that money back from the Fed if I absolutely had to for my business purposes, and I needed to cover some cash flow issues for the short term. I could have borrowed that money back from the Fed for zero. And guess what? Banks like to make money. And so if I could borrow it for zero and loan it out for 4 or 5, I would do that all day long. In fact, banks did do that all day long, and companies borrowed money all day long at really cheap rates, because even at 4 or 5%, companies like Facebook and companies like Google and companies like Amazon and all your other brick and mortar companies, they were happy to borrow money at 4 or 5% or 3% or whatever it is their banks charge them. And that's what fueled a lot of this expansion. And that's what fueled a lot of this economic growth and also this inflationary pressure. Because if the top tier companies could borrow money at this interest rate, individuals could borrow money at a lower interest rate as well, not necessarily 3 or 4 or 5, but certainly at a fairly cheap rate of interest. And that created a ton of not economic growth per se, but a lot of inflationary pressure. And what the Fed has been trying to do ever since March of 2022 with their rate hikes is bring down the rate of inflation. And the way they do that is by increasing the cost of money. Now, if it costs me 4.5% at the bank, if it costs the bank 4.5% to borrow money from the Fed, well, the bank's going to slap a margin on top of that to make its money. So if they're borrowing it at 4.5%, they're going to loan it out at 7, 8, 9%. All of a sudden, a lot of these companies and a lot of these individuals are going to start to think, wow, maybe I can hold off on that expansion. Maybe I can hold off on hiring. Maybe I can hold off on that new project that we were hoping to bring to the market sooner. And maybe we should do it later when money is a little bit more affordable. And so what we're seeing, and we're seeing it in real time, is a contraction in the economy. And this is what the Fed wants. And in the economy contracting, what it's doing is it's bringing down the rate of inflation. And in fact, the chairman of the Federal Reserve Board, a guy named Jerome Powell, in his comments to the media yesterday. So what happens is the Fed meets every 6 weeks for 2 days, and they make their decision on what they're going to do with the interest rate environment on the second day. And then after they've announced their decision, they then talk to the media about what's kind of going on, rattling around up there, and what their thinking is, and what they're seeing, and what the forecast for the future is. And so Jerome Powell yesterday said that they are in fact starting to see things come down, the cost of things starting to come down, primarily on goods. And that was very welcoming news to the market, because the markets are reading the tea leaves and they're trying to project the future, and they're saying, well, gosh, if the Fed is saying that they're seeing the cost of goods starting to come down, they're saying in other terms that the rate of inflation is coming down. And as the rate of inflation comes down, the need for additional Fed action is going to actually kind of dry up a little bit. So maybe the Fed will raise rates again in their meeting in March. That's going to be March 22nd. Maybe they'll raise rates again at the beginning of May. That's 6 weeks from March 22nd. Maybe they won't. And so the markets are trying to predict what's going on as well. But those comments by Jerome Powell saying that the cost of goods is starting to come down, that was very welcome news to the bond market especially. And so interest rates, mortgage interest rates, the stuff that matters to me, stuff that matters to you if you're a home buyer or you're a home refinancer, those mortgage interest rates are starting to come down slowly but surely, they're coming down, and they're continuing to come down because, again, as inflation gets tamed and contained, then the buying power of money in our pocket, that $100 that I've got in my pocket right now, will buy more goods and services as the rate of inflation comes down, and as prices come down, my spending power goes up. And the investors that buy mortgage notes and the stuff that I originate, basically, they get a return that can buy more goods and services in the open market. And so they'll start bringing their interest rates down as well. They'll say, hey, we can buy mortgages at a lower interest rate in the future because the cost of things in the future will also be lower. And so everything's connected. I know that's weird. I know it's a lot of stuff to digest and to think about, but things are moving in the right direction. And they will continue to move in the right direction, I hope. What Jerome Powell said beyond that is that they have yet to see the cost of services come down. Services are still up. And where things are really tight for the Fed at the moment is the cost of shelter. Now, shelter is a service. How you define service versus goods versus whatever. This phone, that's a good, right? That's goods. Services would be rent, for example. It's still tangible in many ways, like your apartment or your rental property is tangible, but it's not looked at the same way by the Fed. And rents are still high. Rents, at least what the Fed is looking at, rents are still high, but the rents are coming down. And it takes a while. I showed you pictures previously of like roller coasters and things like that. Think about the roller coaster that's going up the hill and it crests that hill. Well, if you're at the front of the train, you're already at the top and on the way down. But if you're at the back of the train, you haven't even hit the top yet. And that's kind of the way the rents are being calculated or tabulated as well. They will eventually, the entire train is on the downward slope. And that's what we're going to see in the coming months. But right now, it's just not there yet. So it's going to take a little bit more patience. It's going to take a lot more effort, and it's going to be a little bit uncertain still. It's not a straight shot down. So rates will come down and then level off and maybe come up a little bit and then come down even more. And that's just the way things work. But they are working. And that's the big takeaway. That's the good news. And so we're looking much more favorably at reasonable mortgage interest rates. More and more, we're seeing them in the low 6s to the high 5s. And what we think in the coming months, maybe by the end of this year, maybe by this time next year, what we're thinking is that interest rates will start with a 5. They may even start with a 4, like 4.75 or 4.875, which will be a huge relief from where they peaked out at like 7.5 earlier this year. That's a huge change. And guess what? When that changes, and it will, when that changes, a lot of people who are sitting on the sidelines waiting to buy a home are going to feel that they were late to the party. This is the nature, in my opinion, this is the nature of people. And it's not this person or that person, it's people in general. We all have the same kind of wiring. We're all kind of made the same way. When we see our friends and our colleagues and our neighbors start to do things, we start to think, maybe we should be doing that as well. It's very hard to be the pioneer. It's very hard to be the first person to start doing something that nobody else is doing. There's an old saying, when the entire herd is running toward the cliff, the one that's running the opposite direction is looked at as the crazy one. Same thing here. So when interest rates were like in the mid 6s or the 7s even, not a lot of people wanted to buy houses. It's a true story. A lot of people are like, no way, man, you got to be crazy. But the smart people were saying, well, hey, I know, because I've been listening to Amit's 30-Minute Thursdays, I know that interest rates are going to come down in a year or two. And I know that I'm going to refinance this mortgage at some point in time, and it's going to be a good outcome for me. What I also know is that while nobody else is shopping, I can come in there and start making deals with sellers in a way that I was not able to do in 2021. When I tried to buy a house, but there were like 30 competing offers and they were offering more than what the seller was asking. And I just couldn't. I tried, I wrote offers, I just couldn't win. I'm one of those people, by the way. Let me be personal. I'm always personal, but let me be very, very straightforward with you. My wife and I tried to buy a home in the Scottsdale, Arizona area in 2021. We actually wrote offers, and thank goodness that they were not accepted. There were competing offers and we got crazy. I mean, crazy is kind of a hard thing to say, but we became very impassioned. We let our emotions take over. And I started offering really ridiculous amounts above asking. You know, if the house was selling for $1 million or $1,100,000, I offered $1.25 million. So 15 to 20% above what the sellers were asking for, and they still declined my offer. Thank goodness. I will say that again. I know that I was born under a lucky star, and I know that something or someone is out there looking out for me, but we didn't win. And at the time, it felt like a kick in the teeth. But then we saw the economy shift. We saw the entire Airbnb market kind of collapse or go into hiatus. We saw a lot of things happening. And I think back and I'm like, wow, thank goodness I don't have that huge additional mortgage payment to make when I couldn't really do what I wanted to do with that property. It was going to be a second home, maybe an investment property, but we were writing offers back then and we were escalating above what the sellers were asking because that's what it took to compete. Well, right now, that's not the case, and wasn't the case last month or the month after before that either. And so the smart people, the people that were looking at this and saying, wow, this is an opportunity, they came in and started writing offers below asking price. They came in and started writing offers saying, hey, sellers, we'll give you what you're asking for, but I want you to give me a 5% credit, 5% toward my closing costs and my interest rate buy down. And sellers who hadn't gotten the offers that they were expecting to get from the market in 2021, all of a sudden they started thinking, well, gosh, this is the only offer I've got on the table. I was expecting 10 or 15 or 20 offers, and I was expecting them to offer more than what I was asking. And I got nothing except this one offer, and they're offering to pay me full price minus 5% toward their closing cost and expenses and things like that. I'm going to take that offer. And so a lot of people, the smart people, the ones that were running that way when everybody else was going this way, those people got a great deal. Now, you may say, well, hey, I don't think it's such a great deal. It's 6.875% interest on the 30-year fixed. And we can argue that, and I can show you math, and we can talk about that. But you know what? They got a home that's not jacked up on price. They got a home, let's say it was $1 million. They may have paid $950,000 for that, or $1 million even, with $50,000 towards their interest rate buy down and their closing cost credits, as opposed to buying a home for 1.2 million and paying an interest rate of 3% or 3.5%. So we can argue back and forth about the math, but I tell you this much, the interest rates will change, and we're going to refinance all those folks that bought homes at 6.875 or 7.25 or whatever that interest rate was. They're already in their home, and they're not going to be facing stiff competition to try to buy a home. In about 4, 5, 6, 8 months, we're going to see what I think at least is going to be significantly more competition. And we're already starting to see that. I closed a purchase loan for a client yesterday. It was his first home. I won't give you all the details, but there were 6 competing offers, and he had to escalate above the asking price, meaning that the seller was asking for X. My client had to pay X plus Y in order to win the day. On top of that, no inspection. There was no inspection. So if he bought something and it needs roof repairs, or it's got piping problems or whatever it is, he wasn't able to address that while he was under contract. He also waived his financing contingency, meaning that his earnest money deposit became non-refundable the moment the seller accepted the offer. And we closed that transaction in 15 calendar days. So great for my team. My team does incredible work. New American Funding, the processing, the operations staff, top notch. Cannot complain about that. But if you're a buyer, this is what is going to be waiting for you in a few months across the board. Right now, it's happening here, it's happening there, kind of, off and on. But in 2021, that was the rule. There wasn't the exception. That was the rule. And that's coming back. What's old is what's new. It's going to come back. And so I'm telling everyone that will listen to me, and I hope everyone's listening to me, you still have a chance. You still have some opportunities right now where not everybody has kind of come back into the market. Most people are going this way. If you're going that way, you still have a little bit of an advantage, a little bit of an opportunity to get into a home without paying 20% above what the sellers are asking. Let me give you an idea of what that means. 20% above asking. If it was a $500,000 home, you would have to pay $600,000 just to get the seller's attention. Does that sound like a great deal? Well, but the interest rates are going to change. You're still going to pay $100,000 more than what the seller was asking. And that is a lot of money. And it's going to have an impact on your monthly housing payments. It's also going to have an impact on your out-of-pocket expenses, because you've got to finance that extra $100,000. $100,000 extra at 20% down payment, that's $20,000 more out of pocket just to buy the house. So everything's a trade-off. But as things start to balance out, as things start to stabilize, as interest rates continue to come down, everybody else is going to be going this way now. And you don't want to be in that herd. I mean, you will be in that herd. It's inevitable. A lot of people are going to be in that herd. And I'm excited to work with you guys, regardless of the fact that you may have been sitting on the sideline for too long. When it's time to come back in, I'm good. I'm ready for you. I'm ready to help you with whatever you need. But I'm also talking to folks who are thinking, maybe I should do it sooner than later. My answer is yes, absolutely. Do it sooner than later. Get the good deal now. Pay slightly higher interest rate than you'd like to. But remember, we're going to refinance that interest rate after 6, 8, 10, 12 months. And you won't even worry about that. You know, I find it interesting with interest rates. It's very psychological. It's really, really psychological. Once you buy the house, once you settle in, you've unpacked your furniture, you've painted the walls, you've hung your art, your kids are playing in the yard, whatever it is that, you know, you're settled in. If I were to ask you, do you remember what your interest rate is? Many of the people that I've worked with have no clue. While we were working together, 1/8% of interest or 1/4% of interest seemed huge to them, up or down. Like it was, we're clawing for every little bit we can get because it's really significant. Once they got into the home, once they unpacked and resumed living their life, went back to work, went back to life, were settled in and all the rest of that stuff, learning their new neighborhood, learning where their grocery stores are, learning where their hangouts are, all those other things. Most people just they make their payment and they don't even think about it anymore. They live their lives, they move on. And yet in the beginning, in the initial conversation, it's very rate sensitive. Oh my gosh, the rate, you know, I heard that the rates are really high. Once you're in the house, you're making your payments. You're not even going to worry about the rate. And you're going to be surprised when I call you up and say, hey, Mr. and Mrs. Homeowner, interest rates have gone down significantly. I was looking at your old loan file from a year ago. I think we've got a great opportunity to refinance. You're going to ask me like, really, what's my rate? What is it? I'm like, you don't remember all the negotiations and the back and forth and the pushing and the back and looking and you don't remember that? And most people don't. Most people like, no, we bought the house, we closed escrow, we moved in and we're living our lives. And that's the way it should be. So I urge you guys, especially those of you that are thinking about it, you're teetering on the brink. If you can take it or leave it, fine, do what you think is best. But if you're really anxious, like I got clients right now whose lease is going to expire at the end of April, it's time to shop, guys. Don't be waiting on the market. Don't be waiting on, you know, the interest rates to come down another 1/4% on the 30-year fixed or whatever it is. Get your house now while other people are not shopping, because eventually they're all going to be shopping and you're going to have to sign another 6-month or 12-month lease. And those lease break fees are very expensive. And those other fees are very expensive. And then when you do find the right home, you're going to be offering 10 to 20% above what the seller's asking for it in the first place. And that's also very expensive. And people don't think about that until after the fact, but they're okay with that because, well, my friends are all doing the same thing. And so there's comfort in what's familiar. And it's uncomfortable to be the outlier. It's uncomfortable to be the guy going that way when everybody else is going this way. I get it. I totally understand. But we have a very limited period of time left until these things change and we get into another season where the sellers have a lot more options. So that's the spiel for the day. Let me look at my time here. We've got a couple more minutes. And so I will just tell you that next up on the Fed's calendar is March 22nd. March is going to be an interesting time, but the really big day for the Fed is going to be May 10th. I want you guys to circle that date on your calendar, May 10th. We're going to get the April 2023 consumer price index numbers. And when that happens, we should see the rate of inflation come down even further. And the bond market ideally is going to really love that. And we'll see interest rates continue their trend downward. So we have, and when that happens, it's going to be right in the summer selling season. It's going to be when everybody's starting to really look for homes because they want to move their families while their kids are out of school. If you go into contract May, June, you're closing June, July, you move in the summertime, you enroll the kids in the new school. That's kind of the seasonality of things. So by May or June, I call it June, it's going to be, in my opinion, it's going to be a really tight seller's market again. So that gives us like 3 or 4 months while we still have some control, while we still have some options, while we still have some things. And after that, it's going to be hard to navigate and it's going to be tough negotiations. So I urge you guys, right behind me here is my phone number. Whoop, whoop. I'm still trying to work on the backwards stuff, but it's back here, right? There it is. Good grief. I got to get some remedial help with this stuff. But right here is my contact information. Please call me, email me. Don't be shy. Don't be a stranger. Over here's my new logo, closing loans, cracking bones. These are the 2 things I love to do more than anything in my professional life. It's almost as good as beef and bourbon, but we'll talk about that later. I will explain to you why I have this the way I have this. One of my friends said, hey, why does your house have wings on it? I'll explain that to another time. And we'll talk about other things, about the mortgage industry, about residential real estate, and about beef and bourbon perhaps. But until then, I really hope you guys call me because our window is closing quickly and we've got some great opportunities right now. If you don't call me, that's fine. We'll take advantage of the opportunities that come up later on this year. But that's my number. That's my contact information. Please don't be shy and come back next week. Until then, thank you so much for spending a little bit of time with me today. I apologize for my technological shortcomings, but hopefully we're overcoming them one step at a time. Until next time, stay safe, stay healthy, stay sane, and thanks again for coming. Have a great week. Bye-bye.
Keep it up if you can still see yours.